All right, everybody, welcome back for another video. This will be another update to the Bitcoin Trading Journal series and also an analysis of the Bitcoin weekly close. I generally like to do the weekly close kind of around the open on Monday morning, New York Open. But first we got to start on the weekly, look at the weekly structure, and then go down towards the New York Open. So basically what you see here is you see a trend of the weekly structure making new highs, coming down, testing the lows or the open, and defending the lows and running up and creating new highs, right? We see that here, test the open and the low, run up, defend those lows, then ultimately create a new high, then come back here. Then we see a test down to the low right here, run up. Well, actually, this was, a little bit more of a consolidation right here, but then you do get that push up, right? Again, test of the lows, push up, new highs. So, that same logic really applies here. But I think the key point here is that, if you do have a bullish, even if things are, the weekly is continuing to make new highs each week and setting that trend, generally what you want to see is you still want to open your position, if you're entering a long position at, below the open, right? So typically what you'll see is with all these formations, right? If you were to go here, you get your close here, and then the open pushes down, and then ultimately defends the low. You get here, your close and your open push down, close and your open push down. So those are all really the best ways to add or manage to add risk to a long position in the context of the trend, right? Because generally what you see is the weekly candle opening lower, running below the open briefly, and then reclaiming the open, creating new highs, and then closing at new highs. Generally, if it's a powerful uptrend. Now, I think the key distinction there is that professional traders actually take profit at the close, which is contrary to what most people think, right? Because if you think about it here, right, especially if you have a full-bodied candle, which we really don't have here, but you know, you know, ultimately, traders generally, they're generally going to go long early in the week, below the open, and then start taking profits, as around the close, under the condition where the weekly candle closes higher and creates new highs. So what we can do here is we can kind of mark off those levels right here. Let's go back to the weekly chart. And we've got our weekly open right there, our weekly low right there. We'll just mark that off. And we got the weekly close right there and the weekly high right here. So we'll mark that off. Then we'll go down to the hourly. As you can see here, you got your previous week's low, previous week's open, previous week's close, and then previous week's high. So you can see price has run up just above the high and then run down and breach liquidity. So generally, that is going to be a sign that you have a little bit of a liquidity run to the upside, stop losses are grabbed, and then you start breaking structure to the downside like this. That's generally an indication that price is probably going to go lower, reach for some liquidity lower, down by the open. Now, of course, you do have liquidity below this low, running into the weekly open right here. So any push below either this level or that level is going to run liquidity. And if you just look at it at a weekly chart, it's not a big deal on the weekly chart, right? That would basically just be another test of the open. So I think this is really important to frame whatever swing you're looking at. I really think that weekly open is critical. Now, the trade I took is based on a weekly time frame, so it's a little bit more nuanced than that. I actually wouldn't. I'd be looking to totally take off the position based on a weekly close, a little bit lower than the bottom of the swing. But this is just a reference point. to keep things in mind. So what we see is that we see the liquidity breached during the night, and then during the London session, and then London runs down, runs liquidity, breaks these lows right here. And generally, I think the most common strategy you've seen in intersession plays between London and New York is generally you'll see London lead the direction, and the New York often will offer a retrace into, contrary to London, and then ultimately offer continuation. And that's the reason why the New York Open is a little bit easier to trade and safer to trade because it generally your trade generally leads to retraces. So again, it doesn't guarantee that this would happen, but this is the type of characteristic that is pretty common within the New York Open, right? You get London running liquidity, creating breaks in market structure. Again, it's not a huge time frame, but it is a break of market structure on a certain time frame. And if you see an area like right here, this is an area where I would look to hedge my position, and then I would pull it off. I won't put the orders on during this video, but I would ultimately look to pull that hedge off if price closed the daily above these highs right here, because generally that is a pretty characteristic development. But it's not really favorable to enter a market short right here. Again, you want to wait for the market to come to you. You don't want to chase the market. And again, I am managing a position from much lower. I've got a position of 196 Bitcoin down here at 21,666. But again, that is generally I like to consider the New York Opens when I'm trading price, just because I look for New York to set direction, right? Because crazy stuff can happen over the weekend, but a lot of the big capital is not in play. It doesn't mean that the weekend isn't valuable, but you do want to see how price is reacting at that Monday open. And again, going back to the weekly distinction we mentioned before, generally the week will close and open, and then trade contrary to the whatever trend is occurring in the initial days of the week, and then ultimately close higher later in the week. So you want to be aware of that. That's a way to incorporate the element of time into your trading methodology, and that's something I'm looking at here. Again, that what's happening right now is characteristic of what you would expect if the weekly was going to push down and test the lows after the open and ultimately create new highs. But again, we don't know for certain. So if the market gives me an opportunity to hedge my position, on a retrace after this market structure break, I'll put that hedge in the market. Again, it's not going to hedge all the risk on my position. It's actually going to hedge a very small percentage of risk, probably only 20%. And the reason why it's only hedging a fraction of a risk is because, again, I took the trade on a weekly time frame, and this is a price distinction on a hourly time frame, right? So the risk hedged and the position or the order size needs to reflect the the significance of the time frame on whatever time frame you're looking at. But again, I do think it is very important in Bitcoin to consider the interaction of the weekly chart. The weekly chart and the daily chart, of course, are the two most important charts. And then to drill down a little bit deeper and understand how the sessions relate with one another is also very critical and is only going to enhance your understanding of the market. So I hope you guys got some value out of this video. If you did, just make sure to subscribe to the channel. I'll catch you guys in the next upload.